Hello and welcome to ETF.com's webinar on Understanding Your Exposure, ETFs versus Competing Structures. I'm Rebecca Hampson, European Editor of ETF.com, and I'm joined today by Matt Hougan, who is President of Analytics and Publications at ETF.com, and Alan Lane, Managing Director of 2020 Investments. In today's webinar, we will have an in-depth discussion on how an ETF compares against competing structures. And we will also be looking at how each product works, which factors to consider when buying them, and the model portfolio. We will be focusing on ETFs, index trackers, actively managed funds, and investment trusts, how they all differ, and which pitfalls to be on the lookout for. Before I start, I'd like to remind you that you can submit questions during the webinar through the text box in the bottom right of the screen, and there will be a question and answer session later on with the panelists. Now, the term ETF is likely to be something many of you will be familiar with, and for those of you who aren't, it can be considered a type of mutual fund that is changing the way investors invest. They offer big or small investors access to virtually every corner of the market, and also the ability to build institutional caliber portfolios with greater transparency at lower costs. But firstly, it's important to understand how an ETF actually works, and to do this, it helps to go back to how a mutual fund is set up, which also helps with understanding how the other products we will discuss work. Now, before I launch into a mutual fund, let me be clear on what I mean by a mutual fund. It's a term that's actually most commonly used in the US, and is pretty much the same thing as a unit trust here in the UK. An ETF, for all intents and purposes, is a mutual fund, but with some very special added extras. Like a mutual fund, it is still a structured pool of assets. It has a manager managing the assets in the fund, and it's regulated like a mutual fund. In Europe, that's via UCITS. The added bonus of an ETF is that it's exchange traded. It can be bought and sold on exchange like a regular stock, and whereas a mutual fund can buy and sell stock, it can only do this once a day. An ETF can trade any time through the day, and the trade is immediate. This means you can get in and out of the market when you want to. So how does a mutual fund work exactly? Let's take the example that you and 3 of your friends have £10,000 you want to invest. You don't have time or the expertise to manage money yourself, and it's hard to build a diversified portfolio with only £10,000. So you all come together, pooling your money, creating a mutual fund. Mutual because you're all invested, and you've now got £40,000 to play with. At this point, you're going to want to hire someone who does have the time and the expertise to invest it for you. So you then hire a professional money manager to invest the full £40,000 in the market for you. They are also responsible for who invested what, and in return for the investment, each of you, as each investor, receives shares representing your stake in the total investment. Let's say you get 100 shares worth £100 each, £10,000. Now, assuming your manager does their job well, after a certain time, you might have £80,000. You've doubled your money, and therefore each share of that mutual fund is worth £200. So now, if you do want to realise some of your money, which has doubled, it's at this point you can redeem your shares. This is done by the fund manager going into the market and selling stocks worth £20,000 in order to pay you. Equally, if another investor wants to come into the mutual fund, they can, by buying shares. The only change is that these shares are now worth £200 a share. They then follow the same practice as before by giving their money to the fund manager, who then puts that money to work. It works quite nicely, as the fund manager is paid a fee for their efforts, and the investor gets the exposure they need. In practice, investors buy shares in existing mutual funds. This means that at some point during the day, the fund manager will place a buy order, and they will do this by sending a check to the mutual fund company, or placing an order through a brokerage account, for example. In a mutual fund, this process of taking orders happens once a day. No matter when you decide you want to get in or out of the market, it's done at 4 p.m. Once the fund manager receives money, they will return equal value of shares in the mutual fund. The price of each share is variable, and with a mutual fund, it's determined by the end-of-day price, which is known as the net asset value. This value is calculated by dividing the value of the stocks, or bonds, or cash, or whatever you have in your mutual fund, by the number of existing shares in the fund. The number of shares you then receive is therefore based on the NAV, that's the net asset value, and you can even get fractional shares as well, as you will put in an exact cash amount to the fund, not a specific amount of shares. But the thing to remember here is that the value of the fund, or the shares you get, will be based on the end-of-day NAV price, rather than when you decided to act, which could have been, let's say, 11 a.m. that day. An ETF works differently. When you want to buy shares in an ETF, you can just enter a buy order through your brokerage account or platform, like you would a regular stock. This can be placed at the market price or a limit price, which is the price you've chosen to wait for. The broker then goes into the market, gets the shares, pays the price for you, and delivers you your shares. The difference with an ETF is that you don't pay the mutual fund company directly. You pay the broker, which eliminates a whole heap of administration. And as with any regular stock, you are therefore able to go into the market to buy stock from someone who wants to sell exactly when you want to, and not at the end of day. So where did the ETF come from, and how did it even come into being? Well, if you think back to your mutual fund, the first shares are created by the fund manager taking money into the market and buying stocks. The problem with starting an ETF is that you have to be able to buy and sell shares. But how can you do that? How can you even buy the first shares when they don't exist? It's a chicken and egg problem. The answer is there's a group of institutional investors called authorized participants, or APs, who are authorized to create shares of an ETF. And before an ETF launches, one of these APs will enter into an agreement to create a basket of ETF shares, typically 100,000 shares priced at $25 each. Now, rather than sending the ETF company $2.5 million in cash and requiring it to buy the securities, the APs will go out into the market and buy up all the individual securities that an ETF wants to hold. If, for example, this is an S&P 500 ETF, it will buy up all the individual stocks in the S&P 500 and then ship those to the ETF company in exchange for shares. So the AP who wants to create new shares will buy up $2.5 million of the stocks, making up the S&P 500. He will make those purchases in exactly the right percentages to track the index. So if a certain stock has a weighting worth 1%, then the AP will buy $25,000 of that stock. Once everything is bought up in all the right proportions, it's then submitted to the ETF company, for example, iShares or Vanguard, and in exchange, the ETF company creates an equal value of ETF shares and gives them to the AP on a one-to-one trade. The trade works beautifully. The ETF provider gets the stock it needs to track the index, and the AP gets the ETF shares he needs to sell in the open market. This exchange continues on an ongoing basis throughout the life of an ETF. And as an individual investor, you don't really need to know about this. It does happen in the background. But it's useful to know that this creation and redemption system is arguably what makes ETFs as good as they are. So why be an AP? Well, the answer is obviously to make money. The beauty of the creation redemption system is that it keeps the ETF share price in line with its fair market value. But it's not perfect. What if there's a huge buy order with loads of investors trying to buy up shares in the ETF? Well, because it trades like a stock, the price of an ETF fluctuates throughout the day based on basic supply and demand. And an investor comes into the market with a huge sell order, then this sell order may temporarily send the price of the ETF below its true net asset value, which is below the value of all the stocks and bonds and cash value held by the ETF provider per share. If this happens, the AP can then buy the shares of the ETF on the open market at the reduced value and redeem them to the fund sponsor at full value. It's an instant arbitrage trade and pushes the price of the ETF up towards the true fair value of the ETF. Now, if there's a huge buy order, which pushes the price of the ETF up above its per share NAV, then the AP can buy up the underlying stocks that an ETF holds at fair market value and then deliver those stocks to the ETF company for a new batch of ETF shares at fair market value. The AP can then sell those shares on the open market for a quick profit. This is one of the main ways ETFs differ from closed-end funds, such as investment trusts, where no one can ever create new shares or redeem shares out of existence. There's no arbitrage mechanism to shift the price of the fund back to its true fair value. With ETFs, that arbitrage exists, and it works. Most ETFs trade very close to their true NAV, and the creation and redemption mechanism helps ETFs maintain their low costs. So there in a nutshell is how a mutual fund works, and also how an ETF works. But I'm now going to hand over to Matt Hougan to talk further on which product is the best one for the job.
Thanks so much, Rebecca. Yes, and I think that was a great introduction to how ETFs work. And as you said, now I want to talk about ETFs versus competing products. How do you choose between an ETF and, let's say, sort of core competitors like index tracker funds, actively managed mutual funds, and investment trusts? And I think that's really the choice that investors have out there. There are other options, futures, et cetera, but these are the three real alternatives to ETFs. And it's important to understand that each one has a place. Each one has its pros and cons. And if you want to choose, you have to consider what you're trying to achieve and then find the best vehicle to do that. So let's start with ETFs. ETFs are fairly simple. I think when people think about the pros of ETFs, what makes them good and attractive, they typically come up with 5 things. Their low costs, the intraday trading that they offer, their tax efficiency, the access they provide to everything from equities to fixed income to currencies and commodities, and then the fact that they are transparent, that at any given time you can see exactly what your ETF holds and exactly the market you're tracking. There are cons as well, trading costs, unfamiliarity, and certainly a bit of bad press around some of the structural issues. But when I think about what really matters about ETFs, it's actually those first 2 things. It's the low costs and it's the trading challenges on the con side. So let's talk about why the low costs matter, right? If you look at the cost of the average actively managed mutual fund out there in Europe right now, on the equity side, it's charging 1.35% in annual fees. In the ETF space, the average equity ETF is charging 39 basis points, nearly 1% less. In the fixed income side, you're talking about 84 basis points in average fees for actively managed mutual funds, and a 23 basis point fee, more than 0.5% lower on the ETF side. And those numbers, they may seem small. We're talking about less than 1% in each case, but they really add up. If you took all the assets invested in actively managed mutual funds across Europe and used that average fee, you'd see that investors are paying about 74 billion euros a year in fees. And if all of that money magically transferred into ETFs, they'd be paying just over 20 billion euros in fees. Still some, but a significant savings. And to save you the math, that's 54 billion euros per year, or about 150 million euros per day, or over 100,000 euros per minute. So in the time that we've spent so far talking about ETFs versus competing structure, investors have squandered more than 1 million euros in extra fees for those actively managed funds when they could have been getting their exposure in the lower cost ETFs. I think it's important to note that this cost savings is not just between actively managed mutual funds and ETFs. That's easy to pick on actively managed funds. They have higher management fees. They have to pay analysts to pick stocks. But it's gotten to the point where ETFs are cheaper on average than index tracker funds across Europe. So this is a study that looks at the average cost of a retail index fund. This is from Morningstar data across Europe in 6 different categories, from global equity to emerging markets to sectors to U.S. large caps, versus the average cost of an ETF. And you can see that the ETF wins out in every single asset category. And on average, the average fee on the ETF is nearly half that of the index tracker funds. I think there's a perception out there that these index funds are cheaper, and there are cheap index funds, but on average, investors are overpaying compared to the ETF. And you see that in fixed income as well. The numbers are smaller, but the story is the same, right? The average retail index fund charging 32 basis points on your global exposure, on average charging 35 basis points. ETFs shaving nearly half of that fee off, charging 23 basis points on average. Even for institutional class shares, where you're talking about large minimum investments, ETFs have gotten to the point where they are cheaper on average than the institutional index fund share class. across the board. This wasn't true 3 or 4 years ago, but we've seen huge price competition where iShares and Deutsche Bank and others are fighting to provide low-cost exposure, particularly in large core asset classes. And the average ETF fee has come down substantially to the point where, as this slide shows, you're now competitive or in fact beating out even institutional level share classes for index funds. In the commodity space, it's an even more broad story. The average retail index fund in the commodity space charges an obscene 1.19%. That is for pure index exposure, massively overpriced. The ETF charging 53 basis points. And when you get beyond broad-based exposure, you have no choices in the mutual fund space, whether it's institutional share classes or retail share classes. There are simply no ag, precious metals, energy, or industrial metals exposures, whereas ETFs give you the choice to narrow down into any of those asset classes. In the end, where does this sum out to, right? So it's fine and good to talk about the average fee being lower, but how low can you go if you look for the lowest cost exposure in a variety of asset classes? So earlier this month, we started tracking what we call London's cheapest ETF portfolio. So this is a broadly diversified, aggressive portfolio. It's 60% equities divided between Eurozone, US, and emerging markets. It's 30% commodities. It's got an anchoring, 30% fixed income. It's got an anchoring in commodities and even a small sliver in gold. And what we've done is select the single lowest cost ETF available on the London Stock Exchange in each of these 6 asset categories. And you can see the expenses there. When you total all this up, the combined total fee for this portfolio, giving you exposure to more than 40 different countries, 1,500 different stocks, broad-based bonds, all the commodities in the world, and an anchoring in physical gold is just 14 basis points. That's 0.14%. You could own this portfolio for 10 years for the cost of owning the average actively managed equity portfolio. And I think as we move into a fee-based world and you're an advisor out there, you have to ask yourself, which conversation do you want to have with clients? Which competitive position do you want to be in? Do you want to go into clients with an average actively managed fund costing 1.35%, add on your advisory fee, and be talking to them about a 2.3% all-in fee in an era where we may be talking about 6% returns, 7% returns? That's arrogating more than a third of the total return to fees. Or do you want to go in with something like the low-cost portfolio that I showed earlier and get your fees down to 1.14%, or maybe even shave the advisory fee and get your all-in fee down in the 1% range? I think that's very attractive, particularly when you can give that broad-based exposure, as I said, 40 different countries, 1,500 different stocks, all the commodities, fixed income exposure, and an anchoring in bonds. I think you're going to see more people gravitate to these low-cost ETFs. So it's all nice and good to say that, and ETFs are a fantastic tool, but I do want to point out the other side of the equation, right? There are concerns, we can talk about them in the Q&A if people like, about structural issues and those sorts of things. Mostly I don't think those are very important. But what is very important is that the total cost of an ETF is not just that stated expense ratio. In an index tracking fund, you can buy it and sell it once a day at NAV, and there are no trading costs typically associated with that if you hold it for significant periods of time. With an ETF, you're trading it just like a share. So there are spreads, there are commissions. Those can be significant, particularly if you're rebalancing, and you have to consider those before you make the choice between ETF and index tracker fund. Moreover, you have to consider your own trading capabilities. So this is a chart of a U.S. ETF where you can see that large white blip on the left-hand side was someone who put in a large market order for an ETF with limited liquidity. And while the ETF was trading around $51 a share, their market order priced at over $55 a share, nearly 10% off of the market. And that's simply because they didn't understand how to trade an ETF. A lot of people tout intraday liquidity as one of ETF's main advantages, and it can be great when you want to get in or out of the market. But the price you pay for that intraday liquidity is the complications and costs of trading, spreads, commissions, and if you don't know how to trade appropriately, getting the right price for your ETF. So you do have to weigh those when you consider. In the end, both index funds and ETFs are good choices. Both are low cost. ETFs are now, on average, and in particular, the lowest cost choice out there in most cases. The difference really comes down to the access that the ETFs provide. They provide access to more slivers of the market than index tracker funds, and then weighing off the advantages and disadvantages of that intraday trading capability. In some cases, you may want it. In some cases, you don't, and you can do well with either of these choices. Active funds versus ETFs is another story, though, right? Active funds typically try to outperform the market. They have a manager. They tend to be higher cost. They, like mutual funds, trade once per day, and they're opaque. Their holdings are only published periodically compared to an ETF where you can see it on any given moment. I think the important thing to understand about active funds is while they promise outperformance, in the end, by definition, they can't all deliver. So this is a complex-looking chart that makes a very simple point, which is that in aggregate, the actively managed fund market must own the market, right? They make up such a large percentage of the existing market that on average, half of them would outperform and half of them would underperform before fees are considered. But when you take into account that 1.35% average fee on the equity side, that shifts the pattern of returns, and that's what you can see in this chart, such that your expectation would be that the majority of funds would underperform because of that high fee, and you would have a small percentage of funds outperforming on the right-hand side of that curve. And that's indeed what the statistics show. So this is a chart from Vanguard, which shows the percentage of actively managed funds underperforming their benchmark over a 5-year period in a dozen different categories. And you can see that in every single category, once you consider both surviving funds and the funds that were shut down, the average actively managed fund underperforms. On average, about 70% of them underperformed under this 5-year period. And as you extend out to longer and longer time periods, here's the 15-year chart. This is just a slaughter of active funds, right? In virtually no category did even a quarter of the funds outperform. And in many categories, you're talking about 85, 90, 95% of the funds underperforming the market. It's extraordinarily hard to find the funds a priori that will outperform the market. Studies show that it's not correlated with past performance. If you can do it, that's great. But you're taking an enormous risk by moving into active funds that you're going to underperform the market. And in a client-focused world, that can be the easiest way for a client to fire you and move on to another advisor. I think the last piece people consider when they evaluate ETFs versus investment trusts. The biggest difference between these two products, again, ETFs are open-ended funds. Rebecca brilliantly described the AP mechanism that keeps them tracking close to their true net asset value. Investment trusts don't have that open-ended structure. They are a fixed number of shares out there trading in the market, and that means they can trade to wild premiums and discounts to their true value. That limited number of shares gives them some advantages. They can perhaps invest with a longer-term view. They have borrowing powers. They can retain income. But to me, it's that tendency to trade at premiums and discounts that makes these truly challenging for many advisors to hold. So this is a chart that shows the average discount for investment trusts versus their true NAV over the last 10 years. And you can see that that average discount has varied between 11% when it started. It ramped close to fair value in about 2005. It crashed down, down 17% during the crisis in 2008 and has slowly recovered. In general, that's what you'll see. When the market is doing poorly, these things crash worse because they trade to violent discounts. Right now, they are near their historic high in terms of their average price versus their fair value. And the worry here, again, this can be a client losing situation if you, say, have a market downturn, and not only do your funds perform poorly because the market is turning down, but they perform even worse because they start to trade to a discount. You can't control this. Some people think that's an opportunity if you can buy them at a discount, but it means that you never know what price you're going to get when you exit. So in the end, I think each of these tools has their advantages and disadvantages. ETFs have the advantage of being low cost, of giving you the opportunity to know exactly what you own, of offering intraday trading. I think the closest competitor there are the index tracker funds, where that relationship between costs and trading has to be weighed, and each advisor may make a different choice. Actively managed funds appeal to a lot of investors. Studies show that the vast majority of them underperform. And investment trusts, you have to deal with that unknowable premium and discount, which doesn't exist nearly to that degree in the ETF space. Each investor can make their choice. I think we'll turn it over now to Alan Lane, who is in that position of being an investor, who can talk about why he uses ETFs, how he builds portfolios, and how he weighs ETFs versus other investment choices in his own business. Alan, over to you.
Thank you, Matt. Thank you, Rebecca, for providing an excellent background to the third and final component to this webinar, which is essentially with such a versatile set of building bricks, what's the best approach to actually then turn it into an investment solution for the end investor? I think Matt's done an excellent job of focusing very much on the alternative vehicles. While we will touch upon that a little bit, I think what I'd much prefer to do is to put down a number of the key points that I think any financial planner and financial advisor probably needs to take on board as they make the decision whether they should do the investment piece themselves, whether they should call in the help from the discretionary fund manager. So the first thing is, of course, you always need to know where the beginning is. And really the whole of the topic, in my somewhat oversimplified view, is it's all about asset allocation. If you look back and study where the actual returns come from, to a very large extent, it's very much about the choice of asset classes made as and when the managers rebalance the portfolio. We've had a great exposition on the growth of ETFs. Again, just to put some numbers on that. I mean, globally, you could be talking about as many as 5,000 products. That's quite a lot of products to choose from. Of course, if we restrict our attention to ETFs that are trading on the London Stock Exchange, that might bring it down to a mere 600 or so, excluding exchange-traded notes. So that is quite a lot of choice that one has to work through. Now, in the many weeks and months and years that I've been using ETFs as a key building brick in portfolios, we often get asked that, well, surely that's not a good solution because there isn't the liquidity. And while that is certainly true for some of the products that line the wings of that big list, it's worth being aware of this simple fact that on a global basis, typically there's about 350 and maybe closer to 400 now, ETFs that themselves have more than $1 billion under management. What that tells you is that there's more than enough liquidity for pretty large-sized funds. What is not quite so popular yet in the UK and Europe, but certainly the last 5 years has shown it to be the big stories in the US. This is idea of what they call an ETF managed portfolio. And to a large extent, this is essentially the idea of considering even building the whole of your portfolio only using ETFs, or at least say using 50% of your allocation to ETFs. And at the risk of over-exaggeration, it's probably the fastest growing segment of finance now. Officially, we're talking perhaps $100 billion under management using that approach. But unofficially, at a recent conference in London with some of the key players from the US, they now talk of that actually being 200 or 300 billion. So it's very interesting to consider why these have become so popular and what, if any, role that approach will play in the UK going forward. Okay, so let's get some of the language agreed. When we say model portfolio, what we're talking really is the following. We are not necessarily talking about ETF-owned portfolios. And I think within the financial planners world, they're definitely not ETF-owned portfolios in the UK. While one or two do offer that, I think in the main we should look at it as a combination of perhaps single stocks with mutual funds, index funds, and ETFs. And what the basic idea here is really sort of the next generation evolution of what Rebecca described with the mutual fund model, where you've got a lot of investors, they may be small investors, and to rebalance and manage a portfolio, there's a lot of administrative costs and trading costs, etc. And if you pull that together on a platform where using technology you're able to, share the trading commissions amongst all participants, then as an operating model going forward, this has clearly some good benefits. Now, with the story that I've heard quite a few times now over the last 1 year, say, one often talks of 50% of all net new assets in the advisory space going into model portfolios. Now, even if that number is slightly bigger than it really is, or maybe it's less, then that's quite an intriguing proposition. To me, it definitely tells me that one of the knock-on effects of the retail distribution review, which is sort of about 1 year, slightly longer of age, is that there is now definitely a movement to have the advisors take more control and reap the benefits of this clarity that comes with eliminating commissions, and to make it clear as to, in the whole value chain of what an investor gets charged, who's being paid for what. So I think in the main, the pressure is perhaps more on the discretionary fund manager and less on the advisor, but it's early days, so time will tell there. But when you're selecting a model manager, actually there's quite a lot of things that make that a process that does need a full due diligence, and not just choose a manager on a whim. And I think if I had to select one item from the items on the slides, then it's very much about understanding what does that investor manager do to aim to achieve his asset allocation process and performance that comes with that. While I'm sure there's some gifted people out in the world that can, at a whim, choose which assets to invest in, I do think it's perhaps very important to have a process, to have a system, and to have a degree of consistency, and to have a basic philosophy that says, for the following reason, I do what I do in a rational way, and that's why the idea makes a whole. There is a tendency when you've given a list of assets, and every one of us, of course, is influenced by what we read in the papers, and what we see on the internet, and what we hear on the news. And, that may forced us to take off our exposure into the Russian equity market, say, recently. Of course, the tendency, if you do that, is that you can crystallize your losses, and what was going to bounce back is not actually there to bounce back for you. So, whole range of considerations, very much what you'd expect when you was selecting a mutual fund manager. So in that sense, this is the blueprint for what are the what are the key aspects of investment management, what really matter, and the thing, of course, is there are no shortcuts, and it's about professionalism, understanding how the whole works together rather than only looking at a single aspect. In the same way, the total expense ratio of an ETF, it's important that it's as low as commercially possible, but it is the total cost of ownership, as Matt said, that is the thing that will actually get charged for during its lifetime. The process of working in partnership with a discretionary fund manager should not be done on a sort of North Pole, South Pole basis. It's clearly a team effort where between the two aspects of the proposition, you have to leave the end investor satisfied with all aspects of really what's the service being offered. And again, while we all favour the idea of building portfolios that need the least maintenance and are not over interfered with, there is quite a necessity to make sure you've got a rigorous monitoring process that can avoid too many surprises that are lurking in the wings. Now, as I was putting these slides together last week, actually, I was quite taken by actually what's involved when you try to formalize it to become an investment manager designing an investment strategy. It really is quite a challenge to do a professional job when there is so much that you can do and so much choice to be made. Where do you start? And there's no simple answer here, actually. I think the dilemma that I see repeatedly is the following, and again, it did come up in what Matt was saying only 10 minutes ago. So basically, if you trade and rebalance your portfolio with whatever instruments you're using, then you really do run the chance that you're giving up what returns you had essentially made by crystallizing the losses. And yet, by the same token, imagine you choose to design your portfolio in a way that only requires you to rebalance semi-annually. Then had you chose to be, say, in the emerging markets asset class, or be it on a regional or global basis, then that could really hurt your portfolio. So when we say it's all about the asset allocation, that's where the returns come from. You know, there's no better example than that. You know, India, for example, has performed superbly in the last 2 or 3 months. And some of that is due to political reasons with the way the elections unfolded. But any portfolio that is looking to rebalance very infrequently could well find itself in the wrong asset class. So where do you want to be on that line from too much activity and too little? I think when it comes down to practicalities, we know that there's good reasons why a lot of the providers, both at the institutional level and at the discretionary fund management level, have chosen to package the proposition in the way that we have in the slide in front of us, which is to often view the overall portfolio as a feature driven by the level of risk that we think that portfolio contains. And with that, of course, the suitability as it matches the end investor. Now, we know that there is now this sub-industry of risk rating of knowing your client, understanding whether that's suitable for you, the product is suitable for that end client. And it's perhaps no surprise that we're now finding the regulator is starting to look much more carefully at the providers who do the risk categorization or risk rating of those portfolios. So that is one way to select your portfolio, design your portfolio. Of course, another way is to do it on an investment theme. And I think it's in a world where income is essentially due to us still living in a regime where interest rates are barely above zero for the last 5 years. There will be a constant demand for income due to the implied taxation that comes with that. So they'll always be very popular, but that shouldn't rule out a whole range of other ways of thinking about your portfolio to make a theme that when you tell your end investor that is the theme, then it has to connect with them. It's not an emotionless activity. Okay, well, model portfolios, be they stocks and I was going to say bonds, but not really using single bonds, but mutual funds, index funds, and ETFs operate typically on wrap platforms. The way to think about a wrap platform is it's the next generation that follow the fund supermarket. And the idea is that all the participants in a particular model portfolio can club together and share the costs and additional benefits. Of course, there are some negatives that come with the framework there. The portfolio will need rebalancing, and the way the procedure typically works is I, the fund manager, log on to the system, and with whatever rebalancing framework that my model has set in motion, I will rebalance the portfolio and I will leave it to the platform to execute the trades. Now, if they do not have the volume of participants, then that could be quite a noisy experience simply because sort of the turnover cost versus the number of shares in that particular ETF or other products could get a little bit inefficient. But of course, the other aspect of it is, and I'm afraid to say this is true, that while ETFs have been designed to trade intraday, if you choose to do that, often on an investment platform, you can't get to trade them every day. The platform will have its relationship with the broker in the background, and you're down to the quality of that relationship. So if you were to choose, there is something to be said for going with those platforms that the broker at the back end does have a sort of LSE, is an LSE member. Now, the last key point I would want to emphasize is the process of investment management is not to be done lightly. And essentially, I don't think you can do it without the right tools for the job. We've all come from a culture over the years where tools like Excel provide a great way to do some calculations, do some analysis, very quick and easy to use. But historically, they have shown to be unacceptable as a risk management tool because the level of operational error that comes with having so many potential ways to overtype data, it's very risky. So if I had to certainly leave one thought in your mind, I mean, clearly a lot of you are doing this job already. I'm telling you nothing you don't already know. So apologies to those in that category, but make sure you have got the right tools for the job. And if you haven't, do consult anybody that can give you some good advice there, and that will be the best way to avoid pain. The topic has been well covered about choosing the different instruments. What I will add, of course, is that in the world of ETFs, there is a much bigger list of benchmark indices that are used. and those typically are not offered as a straightforward index fund. So often the ETF is now the most likely vehicle to access that. And another simple truth is so easy to overlook, that on practical grounds, most platforms won't let you trade equity index futures or anything with that degree of internal structure. In that particular case, of course, these might only be 3-month contracts and they roll off, so you have to put the trade back on. But realistically, that's not available for most model portfolios. So the way I tend to think about all ETF portfolios is, if a single ETF is diversified, then a portfolio of ETFs actually is doubly diversified. And what that means is that it comes with its own downside protection. So if you take a basic combination, very much like London's cheapest portfolio that Matt was describing, when you have a big shock in the market, you'll find that the amount that that portfolio goes down is far less than any single stock, any single bond, etc., etc. Of course, that comes with an assumption. That is, you didn't actually trade away or crystallize the losses when those possibilities could happen. But in general, portfolios made of ETFs have inbuilt a protection level that you typically will not see in many other cases. Again, when you think of a single ETF like MSCI World, the sheer number of single stocks that constitute that portfolio is quite a lot. So the averaging effect on a market cap basis to market movements is, the volatility of those changes is far less than a single stock. With so many ETFs to choose from, it does sound like the problem has now shifted to what is your due diligence process for figuring out what ETFs you use, and what skills do you need actually to be able to take on the role that has once been the preserve of quite big businesses with quite a lot of resources. So I think in the future, the idea that the ETF strategist will offer a skill, and it is that skill that will get rewarded, will become more commonplace. So in summary, do all ETF portfolios work? Well, the evidence from the US has been very encouraging. Of course, as an industry, it's not so many years old. I think it will take a few more years for the ubiquitous nature of that to come through. So thank you very much. Over to you, Rebecca.
Alan, thank you so much. That was absolutely brilliant. I'm going to open the floor now to question and answer session. I do have a couple of questions already in. And the first question I think we should go with is, are all the costs of ETFs and mutual funds inclusive of implicit costs like bid-ask spreads, tracking error as well? Alan, I don't know if that's better directed to you.
So all of the costs? No, not all of them. I mean, one has to go through them one by one. I think one needs to write down on a sheet of paper the simple formula. That is the sort of total cost of ownership is you've got the TR that you're paying away. You may get some securities lending coming back to you if they do a good job. Then, sorry, I didn't write down the formula, but she'll just say we've got the basic components to that, and always come back to looking at those to make sure that you're understanding how they've behaved for the product in question.
Okay. Another question I've got is, I think all of us have talked quite a lot about the low costs of ETFs, and there's a lot of emphasis on that. But someone said, surely the priority isn't the cost, as ETFs are just the wrapper. Isn't asset allocation and finding added value more important?
Rebecca, is that for me?
Well, I think either you or Alan, I think it would be sort of quite nice to open that discussion, really, because we do talk about low cost with ETFs.
I mean, I'll go briefly, and then Alan can pick in. Absolutely. I mean, Alan made the point aggressively. Asset allocation is the most critical factor and the most driving important piece of returns. But you might as well use the most efficient tool at your disposal to engage in that asset allocation exposure. There's no reason to layer on additional unnecessary costs if you don't have to. So absolutely, asset allocation first, but you might as well do asset allocation with tools that provide good fidelity to those asset decisions, transparency, and the lower costs is what I would say. Alan?
Yeah, what I would add to that is to understand the case study of what's happened in the fixed income bond market over the last 2 years. Historically, bonds, they trade OTC, unlike equities that always trade on the exchange. And the inconvenience factor, even if you're a big firm like BlackRock, to rebalance a big portfolio has been quite something. And even more so in a world where the markets have been disruptive and you've got this behavior which is what we call risk on, risk off. And cut long story short, many institutional players have found it better as a business model to now use ETFs to manage their institutional portfolios rather than to play the game of single bonds. And I think personally that is exactly why ETFs will and have been successful. And that is simply because you're paying for a convenience that actually it's better to pay that small fee than to have a set of people and a set of processes around you that is actually quite unwieldy.
I think that's a great answer. I've got another question, which is, what is the best time of year to invest in ETFs, if any? I don't know who wants to sort of start with that. Maybe Alan, that might be sort of yours.
Okay, yeah. So we've got some hot weather coming, so I think the ice cream ETF is probably a good one there. Now, actually, that's quite a tricky question, isn't it? I mean, we've heard the cliche, basically, sell in May, come back on St. Leonard's Day, which believes that as everybody in the old days went on holiday to Henley or the summer season, there was not a lot of activity. Of course, that's got no meaning if you look at putting ETFs on a global basis, where maybe you think Mexico is a good play at the moment, which, funnily enough, it has been. So why restrict that question to what's the best time of the year to the question, when can we decide ever to put an ETF? What, should we use bonds or equities? Is there a seasonality effect? Is there a 7-year effect? That is the challenge of investment management, and it's a great challenge, but unfortunately, there's no one-line answer.
True. That's great. I think we had a very interesting question just come in, which is, where is the best place to research ETFs, their charges, performance, tracking error? Is there one place that we can find that information at all? Matt, I don't know whether it's worth running this by you first.
Sure. I mean, Alan would have, firsthand experience. I think, the obvious shameless plug would be ETF.com. We certainly have some of that data, and we'll be adding more of that data in the near term in the UK. We have comprehensive exposure in the US if you're looking at US-listed ETFs, and we're rolling out more and more data tools in Europe. Expect to see developments there in the next few coming months. I think beyond our website, a lot of people turn to issuer websites. You can get some good information at issuer websites. I think there's a question of cross-comparability. If you have access to a Bloomberg, that's an extraordinarily valuable tool. Morningstar has a mix of good data and data I would examine carefully, but they are a good resource as well. Alan, any thoughts to add on top of that?
Well, I mean, ETF.com is in fact superb for this. So, that is not a plug. They're not paying me. They are unequaled in their great job that they're doing. But being fair to some of the others, I think I think just ETF.com, I think they've done a great job in making a very attractive front end to at least see all the products are available, and at least you'll get some really, some really decent output there. The issue of actually measuring tracking difference and tracking error, by the way, it's tracking error difference, apologies, that was missing in my famous total cost of ownership formula. That always turns out to be far harder than you think. I probably spent about 17% of my life at iShares measuring the tracking error and difference of our own ETFs and others. So it sounds easy and should be easy, but somehow it's the one thing that proves to be more of a pain. So I would just encourage all of you to try out a lot of the ETF providers' sites, try out 2 of the 3 sort of ETF aggregator sites, and get a feeling for what works best with you, because through repeated use you'll get more confidence.
Thanks for that, Alan. I mean, I think I would add to that I know that Stephen Walters there's a website called Which ETF, and he has, I think, tirelessly researched every single ETF in the LSE, I think, and it has all the data there, and you can select them and eliminate ETFs that you don't want to look at, and definitely choose that way. I've had another question come in, which is, do you think that the large asset managers will start to roll back their resources used in traditional mutual funds and use them instead to promote ETFs within the next decade, especially in Europe? I think that's a great question. Alan, I think I should direct that to you.
Well, that's clearly a resounding yes, but I need to add a bit of colour to that to make it more convincing. So I think simply that is the big trend we're facing, and one way to think about it is the following: is, well, why is it going to happen? Okay, so Matt, in his presentation, he did have that chart that showed a distribution, and what we're to be reminded from that is in any market activity, there are winners and losers. So the way I see it is that over the next, every year, there's a list of active managers that are often outperformance, and those that are below the average compared to those above the average will be put under business pressure to improve their act. And when they're improving the act, it's unlikely they're going to say, hey, let's carry on doing exactly what we did before. Instead, they're going to say, you know what, I think we could do some things more efficiently by using lower cost index products at the core, or perhaps more use of ETFs in general. And that is the way they will fight back. They won't fight back if they're in the upper first quartile and second quartile, but they will if they're in the losing quartile, which there always has to be losers. So when you iterate that year after year after year, you find more funds will have converted to a higher use of ETFs in the future.
I think that's a really good answer. I've got time for one very quick question, which comes from one attendee who has asked, do you see alternative indexing as the next big driver of growth for the ETF industry? And what sort of caveats should be considered while considering allocation to alternatively weighted indexes and the associated smart beta ETFs? And again, Alan, I probably would like to direct that to you.
Okay, so let's be very brief here. It could take 2 hours, but we'll do it to 2 sentences. So smart beta is a marketing term that tries to get some, frontage to products that can stick out on the list. That's absolutely fine. It's a commercial industry, and if people think they can sell more of the product with that marketing position, correct. But anyway, smart beta is a rule-based approach to describe how you're going to construct your index every month or 3 months or every year on some rebalancing framework. And sometimes they will outperform market caps, sometimes they won't. So the challenge of how to make portfolios that give you great return doesn't go away. What, of course, is interesting is when I think of alternatives, then I'm thinking perhaps more hedge fund type constructions. They generally, and I mean no ill by this, are the last people on the planet that want to tell everybody else how they're doing it. So they don't really appear in indexing formats. What has appeared in indexing formats, and therefore an ETF, is an index that tracks the the returns of some benchmark of some hedge funds, so Deutsche Bank have one, for example, where you don't really get to see what's in the black box, but you aggregate 10 black boxes to make a rule, we'll call it an index, and write an ETF. So yes, there will be more of those rule-based alternative weightings, but you won't really get much active management with hidden features in an index format.
Lovely. Alan, thanks so much. I think that brings us to the end of ETF.com's webinar on understanding your exposures, ETFs versus competing structures. Just to let you all know, the recording and the slides will be up on the site within the next 24 hours should you wish to access them. And I'd also like to remind you that our next webinar on fixed income will be on the 7th of July. This leaves me just to thank Matt and Alan, and